If you've been trying to figure out which index is best inside an IUL, you've been solving the wrong problem. And I don't mean slightly wrong, I mean fundamentally wrong. Because in an index universal life IUL policy, the index is not the engine. It's not the investment. It's not even the strategy. It's just the scoreboard. And people who optimize for the scoreboard almost always miss what actually determines the outcome. So stay with me, because by the end of this video, you'll never look at the IUL indexing the same way again. Hello, my name is Robert Balgach. I'm the founder and CEO of Black Swan Insurance Group. And since 2017, our team has helped protect more than 20,000 families with tax-efficient, downside-aware wealth strategies, and we've earned over 850 five-star Google reviews while doing it. Now, if at any point in this video you realize, wait, I may already have an IUL, or I'm seriously considering one, or I'm not sure if it's structured correctly, there is a link below where you can just click on it and you can book a strategy call with me and my team. No pressure, no pitch, just clarity. Because once you understand how indexing actually works, you'll immediately see whether what you have is built to last or not. And that starts with the mistake almost everyone makes. The first mistake. If you're a high-income professional or a business owner, someone who's disciplined, analytical, and used to being in control, this is exactly how people like you get this wrong. A few months ago, I sat across from a 47-year-old business owner named Mark. Mark owns a regional home services company, about 30 employees, multiple trucks on the road, mid-seven-figure annual revenue. He pays himself well, but not predictably. Some months are great, some quarters are lumpy, and everything depends on him staying sharp. Mark isn't reckless with money. He maxes out what he can. He saves aggressively. He hates surprises. And 5 years ago, his CPA and advisor recommended an IUL. The pitch made sense. Tax advantage growth, no market losses, flexibility if life changed. And Mark funded it aggressively because cash flow allowed it. He chose an index that tracked the market and illustrated it. At the time, he felt responsible. Fast forward to today. Nothing had technically gone wrong, but Mark was uneasy. Here's why. He was in his late 40s now. His body felt different than it did in his 30s. He was thinking more about stepping back, not retiring tomorrow, but having the option. And he realized something uncomfortable. He couldn't explain how his IUL would behave if his income dropped for a year, if a recession hit his industry, or if he decided to slow down before 60. He didn't know whether a great year could quietly create future problems, whether this policy was built for income or just accumulation, or whether the strategy depended on him staying at full throttle forever. His anxiety wasn't about returns. His anxiety was about control. He's done everything right, but he didn't know if this plan was resilient or just working for now. And that's the danger zone for high earners, because nothing was wrong with the index. What was wrong was the mental model he used to choose it. And to fix that, we have to strip away what people think indexing does and start with what an index really is. Here's the sentence that changes everything. Your money is not invested in the market inside an IUL. Think of an index like a thermometer, not a furnace. It measures temperature. It doesn't create heat. Your policy cash value sits in the insurance company's general account. The index is used for one purpose only: to measure whether contractual credit is applied or not. That's it. No ownership, no dividends, no market drawdowns. You are not buying the index. You're buying a crediting formula that references. And once you understand that, the real question stops being which index and becomes what engine is wrapped around the correct mental model. This is where most IUL explanations fall apart, because they never give you the right framework. Most financial products reward focus on one variable: rate of return, cost, or asset allocation. IULs don't. They're systems, not products. Here's the framework that actually works. The index is the scoreboard. The crediting method is the engine. The policy design is the chassis. And your funding behavior is the fuel. The index answers one question only: was the reference value higher at measurement than it was before? The crediting method answers the real questions: how often the gains are locked in, how is volatility transferred, what happens after a good year, what happens when income pauses. Policy design determines whether flexibility exists, whether distributions stay tax-free, and whether the structure survives real life. People tend to obsess over the one piece they recognize, the index, and ignore the three pieces that actually decide outcomes. Once you see that, index names matter a lot less, and index roles matters a lot more. There are 4 index families. Family 1, traditional market indexes. Being familiar feels safe, but being familiar doesn't manage risk. Indexes like the S&P 500 feel comfortable because people recognize them. Inside an IUL, they behave very differently. No dividends, no internal compounding, upside constraint every single year. They can work, but they fail when people expect long-term market returns inside a cap annual reset system. That misunderstanding is exactly why carriers introduced something that looks smoother: volatility control indexes. These indexes were not built to beat the market. They were built to behave. They adjust exposure up or down to maintain a target volatility level. When volatility rises, exposure drops. When volatility fails, exposure increases. That lowers option costs, which allows higher participation rates or uncapped language. Important clarification: uncapped does not mean unlimited. It means the control moved inside the index instead of sitting on top. These indexes reward consistency, and they punish people chasing breakout years. Family 3, multi-asset and dynamic indexes. These indexes sacrifice speed for survival. They blend stocks, bonds, commodities, and sometimes even cash equivalents. They reduce drawdowns, they smooth returns, they often underperform in strong bull markets. People who misunderstand them say, this thing never wins. People who understand them say, this thing never breaks. In 2008, these indexes had a positive year. Family 4, proprietary indexes. The danger isn't complexity. The danger is blind trust. Most proprietary indexes are well designed, but unfamiliarity causes people to either reject them emotionally or accept them without understanding how they behave under stress. And the only question that matters is this: how does this behave when interest rates spike, volatility explodes, or markets flatline for a couple of years? Regardless of index family, outcomes hinge on something else entirely: the crediting methods. This is where the policy either compounds quietly or cracks silently. If the index is the road, the crediting method is how power gets to the wheels. Here's the part most people never see. Imagine 2 policies, same premium, same index. One logs gains annually, the other one measures monthly. After 10 years, one has stable cash flow, the other one just had a good-looking illustration. Same road, different drivetrain, different result. That's why 2 policies can diverge dramatically over time. But here's the part nobody tells you: the rules don't stay static. Why caps and participation rates change. If your strategy requires caps to stay high forever, it's not a strategy, it's hope. Caps and participation rates move because interest rates move, volatility moves, and option costs. Carriers don't change them to hurt policyholders, they change them to stay solvent. And here's the part most high earners don't realize: most broken policies look perfectly fine right up until the year income starts. What you can rely on is the method, the structure, and the adaptability of the design. High illustrated caps often signal fragility, not strength. So why do smart people still chase? This isn't an intelligence problem. It's a psychology problem. Successful people are used to winning by working harder, making decisive moves, and trusting past success. That works in business. It backfires in structural finance. And this is where people like us get trapped, because we assume discipline in business automatically translates to discipline in structure. A good decade can mask a fragile design, which is why disciplined structure always beats clever selection. Here's the order almost nobody follows, and almost everybody should. You don't design from the index up. You design from the income goal backwards. First, will this support tax-free income without breaking? Second, which crediting method translates risk appropriate? Third, which index families play different roles? Indexes are tools. Design is the strategy. And this matters most when the goal isn't just growth, but control. The market doesn't retire people. Cash flow does. Indexing helps accumulate value, but distribution exposes weaknesses. Loans, timing, compliance, sequencing. This only becomes obvious later when income slows, when taxes matter more, or when flexibility isn't optional. A policy can grow beautifully and still collapse under income stress. Growth without structure is fragile. Performance without usability is meaningless. Which brings us to the only conclusion that actually matters. Stop asking which index is best. Start asking which structure survives real life. Because the index is the scoreboard, the crediting method is the engine, and the design determines whether you ever get paid. So if you want help pressure testing your current policy or designing one correctly from the start, you can click on the link below and you can book a strategy session with me and my. We don't work with everyone, only people who want this built correctly the first time. And remember, it's not what you earn, it's what you keep. Enjoy the ride.